Welcome back, YouTube, to the Financially Fit channel. My name is Colton, and today we're going to dig into Tattooed Chef. I got to be honest, guys, Tattooed Chef kind of blew up my channel. It was a complete anomaly as I tested their food. I thought it was pretty decent, and I got a feeling this video is going to catch a lot of hate, but it is what it is, guys. I'm just giving you the details. So let's get into Tattooed Chef. So first thing I want to do, guys, is kind of just rip through their recent quarterly report here. As we can see, revenue rose, 37.3%, which is absolutely phenomenal. Net loss was 17.6 million. Brand SKUs rose to 90 as of March 31st, 2022 from 78. So, it's good to see a bunch of these SKUs, but what we have to understand is that probably the top 10% of their SKUs, top 15% of their SKUs are probably going to be their biggest money makers. So even though that they're absolutely killing it as far as SKUs go, there's a lot of cost here that is probably not helping the company, I would guess. They added 10,000 new points of distribution, so that's going to be good for growth. Gross profit was 8.2 million, which is roughly a little over 11% of the revenue, compared to 7.2 million, which was 13%. Almost 14% of their revenue. And the decline in gross margin was due to greater increase in cost of goods sold. So obviously expenses and inflationary pressures are weighing in on the company. Now, this was a company that stated that would not happen because they're vertically integrated. And so this was a big red flag that I saw going into last year, and there's a big reason why I got out. It was a couple different things why I got out, guys. It was definitely the inflationary costs I could see were impacting them, and more than they were admitting. It was a little bit of share problems, and I also felt that it was a little overpriced when I started digging a little bit deeper, okay? Full year 2022 outlook, they're expecting revenue to be between 280 to 285. We're gonna use 285 as an example. Gross margins are expected to be between 10 and 12%, and obviously they have pretty good marketing expenses. When we think about their burn rate, and then we throw a hefty marketing expense on top of that, and when we go down here and see that as of March 2022, their cash and cash equivalents is only at 57.4 million, okay? So they got 57.4 million, but they're burning capital, and they're looking to spend between 27 to 32 million on marketing. So to me, this is obviously a concern, as we are definitely in a liquidity crunch here where it's hard to get capital. It's hard to get capital cheap, and if you're unprofitable, it's probably even harder to get capital. So therefore, I could see the burn rate being a problem, and I can see dilution being the answer to raising capital, which is fine if they're returning capital to shareholders with growth and free cash flow. When we compare them to the industry standard on gross profit and EBIT margins here, okay, their EBIT margins are currently negative 20%, and the sector median is 8.5%. So as we can see here, margins in this sector are very, very slim. So I'm going to be extremely fair, in my opinion. I'm going to be extremely fair in using EBIT margins here, okay? So let's start plugging in some of these numbers here. So as we can see here, 2019 revenue was 85 million, 2020 it was 148, 2021 it was 213, and in 2022 it's projected to be 285 million, which is about a 34% gain, okay? So year over year average for the company has been about 61% revenue growth. I'm going to use 25% revenue growth from 1 to 3 years, 15% revenue growth from 3 to 6 years, and 10% revenue growth from 6 to 10, okay? And EBIT margins, I'm going to use 0% from 1 to 3 because why are we using 0%? Well, as we can see here, EBIT margins are going negative, so I'm going to give them 3 years to get into the positive with their EBIT margins. Along with that, going from 3 to 6 years, I'm projecting 4% EBIT margins. From 6 to 10 years, guys, I'm being very nice and giving them 9% EBIT margins, okay? Which is above industry standard. Now, that is stating That is stating, guys, that they are vertically integrated, and the next few years we're going to get inflation under control, and they won't be as impacted as your normal food companies. So hopefully management can do what they say, because if they do, I think these are fair numbers, guys. Leave a comment. Let me know if you think I'm being fair or unfair. I'm putting an 11% increase on share dilution, or shares outstanding, as they went from 65 million shares to 71.5 to 82.2. So I'm projecting that they're going to have to raise capital over the next few years, especially these next 3 years, where I do think that their EBIT margins are going to be pretty slim to negative still. And I'm being generous, I think, by giving them 0% EBIT margins. And I do think that they're going to have to raise capital, and I don't think they're going to be able to do it the conventional way, as interest rates are too low and their margins are too slim. So therefore, I definitely think this is a company that's going to have to dilute a decent percentage. Now, if they're diluting 11 to 12% and they're growing revenue at 25%, still could be a buy here, guys. I have them increasing their cash position by 5% year over year and decreasing their debt by 5%. The good thing is they don't have a lot of debt. They actually got their debt down. They're sitting right around $600,000 of debt, and they're sitting on $57 million in cash. As we can see here, they're sitting on $57.4 million and $600,000 in debt. So we're going to project 5% cash growth and minus 5% debt reduction. As we saw, their burn rate is fairly high, and they have a lot of advertising expenses coming up as well. So when we project that out to 2030, we can say that we can see that they're doing pretty darn close to 850 million in revenue. 75 million is going to be the EBIT margin. Free cash flow of about 126 million. Shares outstanding about 210. Cash and cash equivalents pushing 90 million. And their debt would be very, very minimal if they keep. So guys, when we get our final number, if we're looking for a 12% rate of return until 2030, we need to be buying the stock at $4.38. If I put a 10% buffer in there for a margin of safety, I need to buy it pretty much at $4 even, okay? So this is the price target I have personally. Now, I personally think you're still taking on a lot of risk with this company. So for me, guys, I would want a higher percent of return. So I would want a closer to a 15% return. When we're dealing with these growth stocks, guys, it benefits you to give yourself a higher rate of return and build a bigger buffer, okay? So if I got a 15% return and then I wanted to build a 15% margin of safety in there, I would have to buy the stock right around $3.25. So it still needs to come down roughly 50% for this to make sense for risk versus reward for me personally. Is that possible? I don't know. But between $3.25 to $4 could make a lot of sense to enter a position in a company like Tattooed Chef, as it does have a lot of risk. It is growing, but with that being said, they have to execute over the next 6 to 10 years on a lot of different things here, guys. So for me, guys, I would be probably looking to enter at this position roughly between $3.50 and $4. I think it makes some sense here. Now, you all think this might be crazy, but guys, this is just math, and these are maybe I'm being too. I don't know. Leave a comment. Let me know if I'm being too harsh on the company, and if I should expand margins, or if I should expand anything or lower anything. If we lower the share outstanding, I just don't see how they're going to. I see them needing to raise capital, and I see a lot of it coming through share dilution. So I think you need to keep protection in yourself. They don't really have a lot of shares on the market as is. So I do see that, unfortunately, even at these levels, could make sense for them to dilute. Just my opinion, guys. As always, appreciate your time. This was a dive into Tattooed Chef, and thank you so much for spending your day with me. We will see you next time, investors. Peace.